Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you've joined us for the Small Cap Growth Conference. Our next presentation of the day is from Carrier Connect Data Solutions. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book a Meeting. At this point, I am very pleased to welcome Mark Binns, Chief Executive Officer of Carrier Connect Data Solutions, which trades on the OTCQB venture market under the symbol CCDSF and on TSXV under the symbol CCDS. Welcome back, Mark.
Yeah, thanks very much. It's great to be here. Welcome to everyone who's coming to learn about Carrier Connect and our data center story for the first time, and all of our existing shareholders that may be coming back for a bit of an update. To sort of start the company explanation, some of my background is useful. I'm a 5-time public company CEO. I took a company from 2 people and a 3.5-cent stock to 100 people and a $5 a share company with $1 billion market cap. I then exited, retired, and spent a little time consulting in the capital markets. But I was really interested in bringing capital into early stage technology plays. So I created capital pool companies, which are Canadian versions of SPACs. And with my second one, it's called Hopefield Ventures 2, I wanted to find something in the AI space. I wanted to find something exciting, meaty that I could dig into for the next 3 to 5 years. And I was having our AGM with my lawyer, and he said, have you looked at data centers? They're a huge growth industry being driven by AI. And I said, not really, but I'll do some research. So I started doing research, and I'm going to show you you go online and you look around data center growth, and you can find 50 charts that look like this in 10 seconds. What's happening in the data center industry is that data centers are where you store servers that essentially do enterprise computing and essentially run all the computing on the internet. And AI is driving the need for compute power. It's pretty obvious. If you ask ChatGPT a question, they say it takes 10 times as much processing power versus a Google query. What that means is in aggregate, you need 10 times as many servers processing those transactions and requests and queries. And all of these servers, they're just like their computers, essentially. They live in data centers. And a data center gives them power, hook up to the internet, cooling, and data centers also do power backup systems. So if you're a company running your servers, if you are QuickBooks, your servers can't go offline. Otherwise, your customers couldn't log into their accounting software. So data centers have backup UPS battery systems that make sure the power stays on. And they also have backup diesel generators that can kick in and run indefinitely to keep the power on in a data center. So as my research continued, I'm like, okay, this looks really interesting. I actually toured a couple of data centers in Vancouver, saw how they worked. It should note that data centers are co-location data centers, as we call them. The data center doesn't sell hardware or manage hardware. And what I mean by that is the servers inside the racks. These are racks. They're a couple feet wide. They're 10 feet high. They're 4 feet deep. These are all the servers inside the racks that are hooked up to power and the internet. A data center company does not sell the servers, and they don't manage the servers. Customers, their own IT teams manage all that. We're the infrastructure play. We're the real estate play. It's like self-storage for servers. We let our customers put their gear in, hook it up. We provide them power. We provide the internet. We provide the cooling. We provide the power backup systems. We're not concerned about what software they're running or whether they have new patches or even what hardware they're putting in the gear. We rent rack space or lease it, for a better term, on a monthly basis, usually on multi-year terms. So that's what co-location data centers are. I said, okay, this looks amazing. I got to find a data center to get started, to get into the industry. But I knew that buying one data center wouldn't be interesting. It doesn't make an interesting public company. You need a growth story and a way to create value for shareholders. And as I said, I've done this a few times. So what is the investment thesis? And this is the crux of why Carrier Connect is such an amazing investment and why it's done so well and is on a really, really quick growth trajectory path. We're looking for data centers to buy, to put into our portfolio. They're private companies and are usually a single location. Maybe it's 2 data centers, but most often it's one data center, private company. Might be owned by a private bunch of entrepreneurs, might be owned by a corporation that is no longer, that it's a non-core asset, I guess you'd say. A data center company will not sell me a data center. But if you're a software company doing managed services in the IT space, and it's not your core competency, you might sell me a data center. So the valuation we're looking for, what we came to realize with a little bit of time and negotiation and talking to sellers, is that you can usually buy them for 2 to 3 times top line revenue. So if you take an average, say 2.5 times top line revenue. If it's doing $1 million a year in revenue, you should be able to buy it for $2.5 million. Public company valuations are entirely different in the public companies. If you have a portfolio as well, a whole bunch of data centers in different cities, it's worth a lot more than a single location, because customers can put gear in multiple different cities for redundancy, data backup. You can be a lot more valuable in general selling that real estate. So the difference between private single location and public company portfolio companies is vast. There's about a 10 to 25 times top line revenue multiple on public companies with portfolios. They're companies like GoLogix, eStructures, Digital Realty, TerraWolf, Equinix. So we said, okay, listen, even if we achieve the minimum comp in the market at 10x revenue, and we're buying at 2.5 times revenue, that's a 4 times lift. That means every dollar we raise, take, and invest in buying private data centers and putting them into a public portfolio, we should get $4 worth of market cap. And that's exactly what we've seen over the course of the last year with our acquisitions. And I'll show you the chart and how it's working. But that is the opportunity, is really to build a public portfolio from a collection of private data centers. In terms of targets, Canada has 325 data centers. The United States has 5,400 data centers. The vast majority of them, it's a highly fractured industry, are actually small and medium-sized data centers owned by corporations or a group of entrepreneurs. It's a target-rich environment for us. And one of the big reasons they would sell, particularly the entrepreneurs, is they don't have liquidity. They have great businesses. These are cash flow positive businesses full of customers up and running. We're not buying broken companies. We're not buying money-losing companies. But what they don't have is an exit, because the bigger data center companies are things like $8 and $10 billion market cap. They won't buy these one-off individuals. It's not worth their time. But for us to assemble a portfolio of 10, 15, 20 of these, we become an extremely attractive acquisition target to the larger data center companies that they'd like to have these data centers. They're just not going to buy them one at a time and go through that effort, but they would buy a whole portfolio. One more quick thing about data centers. They throw off a tremendous amount of cash. When they reach capacity, which you usually say is around 90, 92% full, because you want some room for customers to expand and you want some room for customers to move around, they throw about 40% EBITDA. The customer base, the churn in data centers is less than 1%. When IT guys put their gear in your racks, they don't ever want to turn it off. They don't want the risk of downtime or customer outages. As long as it's up and running and we're doing our job, they're really, really happy. So sticky customer base, high profit margins. I said, all right, this is the industry for me. So I took my CPC and I bought a data center in Vancouver. I found an entrepreneur who owned a data center, owned it for years, great facility, cash flow positive, great customer base. That customers in his data center for 15 years, doing about $500,000 a year. Very small metro data center, 50 racks, 1/4 megawatt of power. But it was perfect to go public because I didn't have to raise any money to buy it. I had money in the CPC that I put in myself and my close associates. We closed the transaction last February. We're coming up on a year. It was perfect data center to get up running in public with a really good asset without having to do any sort of raise. Then we bought a data center in Perth, Australia. By the way, we are looking globally at assets wherever there's opportunities. Canada and the US are the primary places we're spending our time having, discussions, but we'll buy data centers if there's opportunities anywhere. In Australia, we found a 2 megawatt facility with 220 racks of space. It's like 8 times as big. 3 industrial chillers, 3 generators, absolutely gorgeous data center built for Chevron originally. Ended up in the hands after a couple of different owners of a software company that's not a data center company. They were doing M&A and they basically found a software company they wanted to buy, and it just came with a data center. And they ended up in a situation where they wanted to divest of it, and they had lots of reasons to get rid of it quickly. including a regulatory challenge in Australia where they also had an investment in the fiber ring, and the Australian regulators said you can't have a data center and this investment. And they got their stock halted, actually. So that's why they wanted to move it quickly. So we got a great deal on it. We bought it for $2.5 million. Data centers cost about 20 million a megawatt to build. Sorry, 10 million a megawatt. It would take 20 million to build this place. Has $6 million in hardware in it, meaning chillers, generators, racking systems, etc. And it was already profitable. We picked it up for $2.5 million. We did most of it on a vendor take back because we had just gone public, and we said to the seller, we'll buy it, sort of solve their problem. Great data center, profitable already, tons of room for capacity. And we only paid 300 grand cash and did the rest on a very long 25-year vendor take back that the revenues of the data center already support. This data center at capacity can do 4 million a year. That's 1.5 million, give or take, of EBITDA. And it's also, remember, with our comps, that's worth $40 million in market cap when it's filled up. Then we bought a company in Ottawa called Pure Colo, two 2-megawatt facilities. Fantastic company, been around about 8 years, entrepreneurial led, bootstrap from the start. We bought it for $8.5 million, mix of cash and stock. Some sellers will happily take stock because they understand being part of the bigger company of Carrier Connect lets them realize higher values on the sale, because that stock will be worth more and more as we acquire more data centers and our valuation grows. About 3 times top line revenue, doing about 2.5 million today, has the space to expand into about a $6 million a year business, which is worth up to $60 million in market cap. 40 million to build it if you built it today. Tremendous acquisition. So that was data centers 3 and 4. And then that was by the end of last year. Early this year, we just announced another data center in St. John, New Brunswick, which gives us national coverage in Canada, West Coast, Central in Ontario, Atlantic Canada, 0.5 megawatt facility, really strategic facility out east that has a lot of great customers in it. It can do about $1.8 million a year, 18 million in market cap potential. It's an already profitable business. And we expect to actually close that in the next couple of weeks. That's an LOI that we announced just over a week ago. So that brings us up to 5 data centers. The plan, and I wrote this slide a year ago, was go public in February, acquire 2 more data centers by the end of the year. We actually ended up with 3. So we had 4 by the end of 2025. The plan for this year is to buy 4 to 6 more data centers. We've announced St. John, and we have a tremendous pipeline of opportunities that we're in discussion, negotiation with, LOI discussions to bring into the pipeline even early this year. It's going extremely well. The model is working as we're seeing in the market. And then we thought originally we might build some data centers next year as we got larger and could raise larger sums of money. I don't think we're going to do that. This model is working so well, we're going to keep doing it until something changes. There's lots of targets. They're looking for liquidity. We can buy them, and any money we raise, put it in and get, as we say, a target 4x or $4 a market cap for every dollar spent. I mean, last year we did total acquisitions running around 12 million, and we have about a $50 million market cap. So it's held really nicely, and I'll even show you in the chart in a second. The team, I talked a little bit about myself, public company CEO, got a really good network in the markets, ability to raise money, ability to market the story and make sure that we have the support on the Pubco side. I'm also a technologist. I have a computer science degree. I've worked in tech my whole life, but data centers are always, a bit unique. Everything is. So John Arnett was the owner of the data center in Vancouver. And when we said to him, I want to buy your data center as our first data center, do you want to be part of this much bigger vision and growing this company? And he said he absolutely wanted to. In fact, that's the only way he wanted to do it. So he's our CTO. He's my partner in the business. He knows everything about data centers, all the specifics about running them and really how to evaluate them. When we're doing M&A, he's going to understand the nitty gritty of the cooling system and whether it is, up to date, modern, well maintained, and things we want, just to take one example. So great partnership between John and I. We have 2 great guys on the board. Mitch Demeter, he was with me through a lot of success. He now lives in the Caymans, sits on boards, has made his money, and great advisor. And then we have Peter Smirniotis, who's a director at Victory Square Technologies. Also really, really tapped into early stage technology company growth and scaling. Perfect guys for sounding board for John and I. And we have one advisor, Dan Barnhold, and him and I actually had a lunch couple of years ago, we sat down and said, let's start building some CPCs. And that's what created Hopefield Ventures 2 that turned into Carrier Connect that we have today. He runs Luca Mining for about the last year and a half. Tremendous returns for his shareholders, but he's a career banker and has us very connected to the capital markets, of course. Here's the cap table. Super proud of this cap table. We didn't let anybody in to the cap table we didn't want. We didn't, do a bunch of deals with what I like to call the House Street Hustle guys. We kept it really tight, did our own marketing, did our own cash raises, 25 million shares outstanding versus you typically see 80 to 100 million at this stage probably. John and I own about just under 20% of the company. It's probably 20% institutionally held as well, which is a hugely good sign for an early stage company, and about 60% retail. And there's really only about 9 million shares free trading, and probably actually less than that in reality because John and I own a bunch of the free trading shares as well. And that's how you get a nice controlled stock chart. We went public here. We announced essentially that we were going to buy the Australian acquisition. The market give us value for that, and then we close it. Then we went through the summer basically getting ready to buy Ottawa, negotiating, raise some capital. Right here is when we actually announced that we closed the financing that would allow us to buy that Ottawa 2 data centers. We closed it, and then we got re-rated for the acquisition and the revenue in the acquisition. And now we're bouncing around right up here. Just announced the St. John acquisition. I believe when we close it, we'll get rated for that as well. And we have, again, a lot more data center acquisitions very close on the pipe, and will continue to be valued as we acquire them. Here's some projections for the year. Sitting from where we are, I guess we're just at the start of February, we are just shy of 5 million in annual recurring revenue now, including St. John. And we believe we can get to 15 million in annual recurring revenue this year, primarily through acquisition, but also through growth in the existing data center portfolio, which will be a very good return stock price wise as you do the math. Acquisitions are a big catalyst. We're really primarily on the last slide here. So right now it's about buying and acquiring these data centers. As we make the announcements and close the deals, we're going to get re-rated each time for the revenue and the growth in the business. So those are obviously big catalysts. We have our US QB listing. I think we probably have a lot of Americans listening today. You can buy it on the QB, CCDSF. We're going to start doing a lot more marketing south of the border, where there's a really good understanding of data centers, technology, AI. And we think that's going to be very good for our investors and our stock. We do have space to fill in the data centers we bought. Again, they're not broken businesses. They're really, really good businesses, cash flow positive, full of customers. Ottawa's got 60 customers in their data center, but there's room for more. And the data centers we acquire are all modern and up to date and don't require CapEx to add revenue. So we can add a very, very profitable revenue just by putting new customers into the rack space we have. And then finally, have to tell a story. Nothing happens in a public company if nobody knows about it. So we're out telling the story. We're going to do a lot more marketing this year, which will be very good as we're adding assets. And then you got to run the underlying, what I call the private company underneath and make sure it is growing and thriving. But you also got to tell a story. So we'll be in the market, letting people know. I'm actually doing 2 OTC Markets conferences this month alone. I'm doing a conference with Singular Research. There's a lot of stuff happening. So that's essentially the story. I'm going to check on the questions now and bring those over and see if I can help. Given the surge in AI demand, do you see opportunity to pre-sell capacity at premium pricing before you're fully built out? Yeah, potentially. It's actually interesting. When I actually toured Cologic's data centers, I was amazed. They were still in construction, some of them, and they were selling space 6 and 12 months in advance to customers that were looking for space. So, we're always looking at being at the market with current pricing. And it's a bit of a jigsaw puzzle. Sometimes people want more space than we have. You can't service it. And if they want small amounts, then you can put them in. But, we have long-term customer contracts. We have customers that have been around, as I mentioned before, 15 years. The churn is really low. So we'll maximize the revenue in the space available. How do you compete against hyperscalers and established colo providers? One of the things is demand in the industry exceeds supply. there's a lot of cooperation in the industry. We've had larger hyperscaler type businesses send us customers because they say, they don't fit our customer profile. We're charging twice what you're charging because we have, other levels of security, like bomb sniffing tubes. I like to talk about them. You walk in and they puff air all over you. We don't have those at our data centers. We don't need them for our client profile, and we can provide a more affordable price per rack on a monthly basis. And unless you are, Oracle, you're not as worried about that sort of level in the data center. So we fit where we fit. We're sort of mid-market. We keep people really happy. And the demand out there, again, generally exceeds supply. So that is working very much in our favor and was a huge reason I decided to get into the industry. So someone says, you talk about adding 4 to 6 data centers in 2026, potentially in other markets like South America, Europe, but what's the ideal acquisition look like? It's a great question. Number one, profitable. Whatever size it is, we're not looking for broken businesses that are losing money and need to be turned around. Doesn't fit our model. We want to take something, be able to plug it in and know it's stable and a great company day one. The second thing is modern technology. So as their chilling systems, their generators, their racking systems, up to date, both in terms of what they are and are they well maintained. We don't want to have to go in and spend $1 million replacing a generator right after we buy a business. We want to know that it's good, the batteries, the maintenance that are done, it's up to date. Same with all the different pieces. So we don't want to have CapEx. So profitable, ideally, break even or profitable, not requiring CapEx, well maintained. And then finally, room for growth at whatever size that is. If a data center that we buy is already profitable and it's at 30 or 40% capacity, that's actually better than profitable and at 90% capacity, because it means we have even more room to generate revenue and growth out of it. And all of the data centers we've acquired have room. Vancouver's quite full, but it was the first one, and it's a smaller of the bunch. We're typically looking at $10 million in ARR, or maybe 5 megawatts of space or smaller, which is actually the majority of the data center market, as I mentioned earlier, because it's really, really fragmented market. Market One and Benzinga Frame Care is the only public Canadian consolidator in the space. How are you leveraging that first mover advantage? Yeah, it's a great question. I believe we are the first mover. I don't know of any other public company or even private company rolling up data centers. We're leveraging it because in negotiations, there's no other party negotiating. Every time we've talked to sellers, we're the only company out there right now actually doing this, and it allows us to have, and I know there's not other buyers, so it gives us more leverage in the negotiation. We've had negotiations that have lasted a couple of months, and we've reached very happy. I think both sides are happy with the terms, but really it's coming down to price and knowing that we're not really bidding against someone else. We're only trying to find a happy selling price for the sellers and a happy buying price for us. And we have a very simple model. If the price is going to be over our acquisition target price, no matter what, we're not going to do it because that breaks our economic model. So we just keep with our plan and execute on that. And if the data center fits, then great. And if not, there's lots more out there to buy. We've been recently featured on BNN, Market One, around AI infrastructure. How's it increased interest in the AI and cloud customers? We have interest every single day. I believe it always helps, of course. The more places your name and brand gets out, the better. But, we have a lot of inbound customers or prospective customers looking for space, small space, big space, different countries. It's great that we have different footprints to put them into. We have a sales team in Ottawa that came with the acquisition, and they love the fact that now they can actually sell space in multiple different cities or geographies, or they can take their Ottawa customers and also give them space in Vancouver, soon St. John, and upsell them. And that way they have more redundancy and stuff. So it works very much to our favor. Someone's asking about, what is the must-have next geography? I don't know if there's a must-have. We're looking for good opportunities, good data centers. I sort of talked about the criteria before. I do expect we're going to have some in the US soon. That'll give us, Canadian coverage east to west. We'll start getting some US coverage for people that want to be south of the border or north of the border for data sovereignty. It's a big thing. People are coming out of the cloud and going into direct servers in data centers so they know where their data is stored. And if they want to be in the US or Canada, if we have data centers on both sides of the border, that's to our benefit, right? It'll help us increase customer growth. All right. Okay, so the question is here, we talk about Carbon 60, which is a great addition to national coverage. How quickly can the asset contribute a meaningful EBITDA? Well, as soon as it's closed, I mean, literally the first day you start counting the revenue after we close, the first month, the full month's revenue from that data center will flow into our consolidated P&L. So right away, it's what I love about acquiring these data centers, whether it's an asset purchase or a corporate acquisition. Either way, right after we close, which is, every data center we have a target, whether it's a month or 2 months, to do all the legal due diligence and close and make sure everything goes well. We'll be getting the revenue right away and showing up in the first quarter after it closes. We're talking about dual listing. Someone has a question about appearing on various platforms. At what scale or EBITDA do you think the market begins to re-rate you? Right away. In fact, I'm going to jump back to my chart here. You should be able to see on the screen. As soon as essentially, we closed the Ottawa acquisition literally here, and we re-rated directly after it. Starts on day one usually, and people have to hear the story and have to go and tell it. But the re-ratings really happen quite quickly. Investors are very smart. Markets are efficient, and as we continue to add acquisitions, throughout the course of the next couple of quarters, I believe you'll see those valuations baked into the stock really, really quickly. Strategic or cornerstone investors that we might be looking to bring into. Institutions. We're at the institutional investment stage. Usually you hit around 40, 50 million market cap, and institutions will come in. These are, long only funds that'll sit and buy and stay in your story for years. That is where we're at now. That is who we're talking to in the market. I've done a lot of meetings with institutions just lately that are very interested in being part of this story going forward, and are not here for 1 week, 1 month, or to make 10%. They're long only funds that are, they want to make 5x and 10x their money. Those are the kind of guys that we're bringing in. Family offices as well. And then, index funds. There are data center index funds out there that once we get, to a certain scale, we'll get included in. And then everybody, all the funds that track the index will buy our stock. I've done it before. And I'm pretty keen and excited for us to get included in those funds as well. We're getting near the end. There's a question here around high density workloads, AI firms. The majority of our customers are enterprise compute, right? So they've been around years and years and years before AI was ever a thing, and that's what most of our data centers are full of. The good part is they're long-term stable customers that are not they're recession proof. I mean, even through COVID, they didn't move, they didn't go anywhere. Their businesses are still running, their email still has to work. We make it into simple terms. But with new space being filled up, we're seeing a mix of AI and enterprise compute. We can handle it. We're nimble. One of the advantages of us versus a giant cookie cutter hyperscaler is we can say, oh, you want direct liquid cooling. We'll make a cage for you guys, or your own room within the data center. We'll run plumbing in. You can run the liquid through your servers. You're going to pay us a premium for that. They're happy and we're happy. So right now it's a smaller percentage, but it can grow. And there's definitely the interest out there in the market. And I think we'll stop there. It's 9:58 here. I really appreciate everybody coming and getting a look. I think it's a tremendous investment opportunity as we grow the company. We're at scale, we're stabilized, and we're going to have a really big 2026 in terms of acquisitions, which drive shareholder value and growth. So thanks very much. And my contact information is at the bottom here, marketcarrierconnectds.com. Feel free to reach out if you have any questions, if you want this investment deck or anything else. Thank you.